So good afternoon, and thank you for joining today's investor update for Hela Apparel Holdings, covering our recently published financial results for the third quarter. My name is Adam Collins, General Manager of Corporate Affairs and Investor Relations. I'm also joined by our Group CEO, Delanka Janadasa, our Group CFO, Ruan Fernando, Deputy General Manager of Treasury, Navoja Pramaratna, and my colleague from our corporate team, Shannon Gomez. To outline the agenda for today's call, we will start with a presentation of around 20 minutes that will cover our Q3 results, and then we'll move on to an update on the outlook for the coming quarters. The presentation includes a few slides on our social capital initiatives, which we will not be presenting in the interest of time, but we will be sharing this presentation with everyone via email after the call, and we would encourage you to take a look at these slides too. We will also be making the recording of this call available on our YouTube page for any colleagues who weren't able to join live today. And following the presentation, we will move on to a Q&A session for the remainder of the call. Questions can be shared through the Q&A box on your screen, and we would encourage you to send these in as we go through the call. And one final thing before we start is a quick disclaimer on forward-looking statements. Any such statements are based upon the management's current reasonable expectations and assumptions and are subject to known and unknown risks. Given the risks and uncertainties that may cause the company's actual performance to materially differ from that expected or implied by these statements, we advise you not to place full reliance on them. We also do not undertake any obligation to update these statements to reflect future events or circumstances that may arise. And with that, we'll move on to the body of the presentation. So I'm going to start with an update on our Q3 results, which were just published on Friday. So this slide shows a snapshot of the results for the quarter. And so the overall story is that it was another challenging quarter, but one where we showed important areas of improvement. So starting on the revenue side, we saw a further dip in revenue. So it was 14.4 billion for the quarter, which was just under a 17% quarter-on-quarter reduction against the second quarter, and it was about a 34% reduction in rupee terms year-on-year, and that is primarily driven by the movements in our underlying US dollar denominated exports. There was about year-on-year about a 10% depreciation in the rupee against the dollar, but still there was a 27% decline in our US dollar revenues. So that's reflecting a couple of factors. One is that it is still challenging operating conditions for apparel brands in our key markets, and that is still being demonstrated in a cautious purchasing approach. But it is also important to note that there was a particular factor in the Q3. So there was a significant revenue drop in October in particular. That was quite unusual, and we think was primarily due to some seasonal factors. And that was not a sustained drop. It was reversed in November and December, and we saw a pickup in revenue in those months. But because of that significant dip we saw in October, which we also believe was mostly industry-wide, that has pulled down revenue for the quarter overall. But despite this, while profitability is still not where we would like it to be, we did demonstrate an improvement. So on a quarter-on-quarter basis in particular, and that's really demonstrating the initial impact of the steps we've taken under Project 180 to reassess, to realign the cost base to this level of demand. So in particular, we saw, even though we saw a significant decline in revenue Q on Q, we did see gross margins pick up slightly further, and this is the highest level that we've seen year to date, though we do see room for further improvements. And in particular, a particularly important factor was that we saw significant or marked declines in administration and distribution costs, which really helped to support an improvement in the EBIT margin to bring in a smaller operating loss as well, which has trickled down also to a reduction in the PAT loss as well. I think it's fair to say this is still not where we want it to be, and there's certainly scope for further improvement. But this is really demonstrating that despite this, a significant revenue drop in the quarter, we have seen a notable improvement in the margins and in the bottom line as well. So to move on to my next slide, I won't dwell on this too much. This really just reiterates the points I've just run through. I will just touch on the chart on the right-hand side, which shows the composition of our revenue by country of manufacture. So what you'll see in the dark blue bars, which is showing the Sri Lanka contribution, is that has been increasing over the past few quarters. And that certainly continued in Q3. And that's really coming at the expense of Kenya. So a really important factor to bear in mind is that last quarter, so in September, we downsized the Kenya factory, which is something we mentioned on our last investor call. So we reduced the capacity there by about 40%, which is what you're seeing coming through there as a shift towards the revenue the revenue composition towards Sri Lanka. So to put the quarterly performance in a bit more context, this slide is showing the quarterly revenue on the left-hand side and then the operating profit on the right-hand side. So you'll see that there was a significant notch down from a revenue perspective in the third quarter, really bringing it back to those levels that we saw in the FY 21-22 financial year. But despite that, we have significantly reduced the operating loss in the third quarter. As I say, it's still not where we want it to be, but that is showing the validity of the approach that we've taken through our Project 180 strategy, which I'll have more to say on in some later slides. To give you an idea how this looks, say, from a capacity perspective, but also from a country perspective. So what I'm showing on the right-hand side is our sold standard hours by country of manufacture, and then the group on the left-hand side, and that's showing it for the last 3 quarters. So very similar to the revenue performance, we've seen a marked decline over the past 3 quarters, and that's particularly coming out of Sri Lanka and also Kenya. Kenya being also partly driven by that intentional downsizing. So it was about, between Q2 and Q3, it was about a 13% quarter-on-quarter decrease in standard hours, which to some extent matches that what we saw in the revenue. But I think the crucial point here is that across this period, we have been reducing our capacity. That's really what that step in Kenya was about. So since last year, we've had certain recruitment freezes in our manufacturing facilities, and then also the downsizing of the Kenya facility in September 2023. So this all means that as a result, capacity utilization rates remained relatively stable in the third quarter as compared to the second quarter. So despite that dip in revenue, we've managed to hold on to that capacity utilization because of the capacity reductions. So really, as and when we do see an improvement in the revenue base, those capacity utilization numbers in particular are set to increase. So a quick word on on administrative expenses and distribution expenses. So as I mentioned earlier, we did see a marked drop in both of these. So on the administrative expenses side, you can see that it's about if I'm getting this right, about a 30% quarter-on-quarter drop. And that's really despite an LKR appreciation as well. And that's really reflecting the cost control measures that we've undertaken as part of our Project 180 strategy to realign our cost basis to this new lower level of revenue. And then on the right-hand side, I'm showing distribution expenses over the last 8 quarters as well. Important to say that both of these charts are in US dollar terms, because that is our functional currency. And so on distribution expenses, what you're also seeing is we've seen a significant reduction in the third quarter as well. And that's really coming down very significantly from the last financial year. And that primarily reflects a reduction in our unplanned air freight expenses, which is a reflection of the Project 180 focus on operational excellence, which is really bearing fruit there in terms of bringing down distribution expenses. So it's really these factors which have led to a significant improvement in the profit margins in the third quarter. So that is summing up on Q3 performance. I'll now run through a few slides looking at Q4 and beyond. So this is kind of an overview. So our current order book suggests that we will see a significant quarter-on-quarter pickup in revenue in Q4. As I say, a significant portion of the revenue dip in the third quarter was driven by October in particular, and we've seen a recovery since then. And that is continuing into Q4, so the first 3 months of the year. We're expecting an increase, as I'll see on the next slide, of something around or even in excess of 20% quarter on quarter in US dollar revenue terms. At the same time, we're working on continuing to implement our Project 180 strategy, and that will continue to drive improvements in performance in future quarters. And then finally, we do also have the positive impact from our recently announced acquisition of Focus Brands at the end of January, which will therefore be consolidated into our accounts in the fourth quarter, which will support revenue profitability and also have a positive impact on the balance sheet as well. However, it is important to say that beyond the fourth quarter, there are a number of risks on the horizon. So from a demand perspective, it remains somewhat stable, but it is uncertain there. I mean, the consumer demand conditions in our key markets remain challenging. We've just had the UK enter a technical recession as well. And then from a major central bank standpoint, expectations of very rapid rate reductions are sort of reducing as it were. So it may take more time than expected to see a sustained recovery. And then adding to that, obviously from a geopolitical side, we're seeing disruption to shipping via the Red Sea, which is really complicating the outlook. And it's contributing to a significant increase in global shipping rates and also lead times as well. So it's a factor which we are navigating through, and it's certainly an additional headwind in addition to the demand picture as well. So to go into a little bit more detail on the demand outlook. So this chart is showing our produced standard hours on a monthly basis over the past 12 months or more. And then with the forecast on the right-hand side for the coming quarter in the light blue bars. And then the red line is showing an approximation of our monthly capacity. And that's coming down because of the capacity reduction measures that we've taken. So as I indicated on the previous slide, our current order book, which is mostly it's very heavily based on confirmed orders, is showing about a 20% quote-unquote increase in loading in Q4. And we are seeing that likely to transfer into a similar or even more quote-unquote increase in revenue. So that is still significantly down from the capacity which we had in the same quarter of the previous year. But because of those capacity reduction measures that we've taken and the improved capacity utilization as a result, we should also see that improving the bottom line as well. Beyond this, the current outlook, which is more uncertain, is showing essentially stability going forward. It's not demonstrating a sustained recovery, but it is showing stability, suggesting that the significant declines we have seen over the past year have, as it seems now, more or less come to an end. And importantly, that dip that we've seen in the third quarter was not the start of another sustained downward leg. It seems to have been a blip, and that going forward, we should see more of a stabilization. So in this context, we are continuing to focus on our Project 180 plan, which I'm showing the 4 pillars of here, just as a quick reminder. So it's around cost and capacity rationalization, operational excellence, incomparable products and services, and strategic investments, which I'll say a little bit more on in the subsequent slides. So from a cost and capacity side, this is a slide which I showed last quarter, which is essentially summing up the measures that we've taken and the progress. And I think the key thing I would draw your attention to is the table at the bottom, which shows our extensive progress against our targeted savings. So particularly from a manufacturing cost and SG&A side. And so while in mid-November, when we had our last earnings results call, we were about 60%. We now have progressed up to 90%. And we have further to go on the manufacturing cost, but those are the initiatives we're working on now. And in addition to that, we are exploring additional measures beyond this plan to take the cost base down even further than this. So that's something that we'll be working on in the coming months and the coming quarters. From a customer side, a few important developments in the current quarter. So from a market diversification perspective, we've added a new Spanish customer, which is Women's Secret. And they're particularly very keen on women sourcing. So we'll see that first delivery for them coming in the fourth quarter of this year. And then beyond that, a couple of newer relationships as well. One being a pair of thieves, which is a fast-growing US men's underwear brand, for which we'll see deliveries for in the first quarter of the next financial year. And then also from a Nike side, which is a customer we've been talking about over the last few quarters as well, which we onboarded, say, mid of this financial year. We're seeing our relationship deepen with them. So we've just had our first order for Nike Jordan's men's underwear, which is a new product line for us with them. So you can see a positive scope for growth from them as a customer. So that'll be going for delivery in the second quarter of FY25 as well. So positive progress on that side in terms of market diversification and reducing some of our customer concentration. These are also customers where we see significant scope for further growth as well. And then a quick couple of slides on the acquisition of Focus Brands. So we had a separate call on that a few weeks ago, and so that's available on our YouTube if anyone missed that. But as a snapshot, so we've acquired 100% of Focus Brands Limited, which is a major UK-based apparel brand licensing house. Some key facts about the company are on the right side of this slide, which I won't dwell on too much. But the key is that this transaction was completed just at the end of January. And so we'll be seeing the financial consolidation of Focus Brands in the fourth quarter for February and March. And so that is expected to have a positive impact on revenue, profitability, and key balance sheet metrics. And it's important to note that there is no additional debt, or no debt was carried by Focus Brands at the point of acquisition as well. So it's not in any significant way adding to our debt burden. And in addition, we are expecting a one-off valuation gain on the acquisition to be recorded in Q4, which will be a further support to profitability and balance sheet and the balance sheet in the quarter as well. And in addition, we are, so as it says here, Focus Brands is very much the foundation for our new brand licensing division, which is going to operate independently of the existing business. But we are also seeing significant opportunities for synergies and kind of further growth for Focus Brands as well. So just wanted to kind of update you that even post-acquisition, we're seeing a lot of positive opportunities go forward. So from a cross-selling opportunities perspective, and by that I mean is the ability for us to use some of Focus Brands brands portfolio in order to sell to some of our existing customers and vice versa. We're seeing a lot of positive interest from our customer network to engage in the Focus Brands portfolio, which is really opening new avenues of growth for both Focus and Hela as a combined entity. And in addition, through Focus Brands' existing network of licensors, we're seeing a lot of interest in potential major new brand licenses as well, which would really strengthen the Focus Brands portfolio and open avenues also up in that respect for further growth as well. So with that, I'm going to stop. That's the summary of the presentation. As I say, these social capital slides here for your reference. But with that, we will move on to the Q&A section of today's session. And I can see that there are a number of questions which have already come in. So we'll just start to run through those. Yeah. So the first question we have is on administration costs and distribution expenses, and can we provide the reasons for the reduction in these? So Ruan, I'll let you take that one.
Yeah, so as Adam explained during the presentation, it's basically coming from the P180 initiatives in terms of administrative cost, which we were focusing mainly on reduction in our SG&A initiatives being, we have gone on a recruitment freeze. So we have seen a significant reduction in administration expenses because of that. The distribution cost is mainly coming from our freight cost reductions. So we have been performing well in terms of on-time delivery, so which is a significant reduction that has come compared to the last Q3 of last financial year.
Yeah. Okay, thank you. Maybe in terms of average selling price last year and quarter, I think Rowan or Dylan, I could let you take that, but I think we would say that's not been the main driving factor in terms of the revenue perspective. It is primarily volume based. That's fair to say. Okay. On next question we have is on depreciation and amortization. Given that has increased significantly compared to last year, and what the reason for that is. So I think that's looking at the LKR cash flow, which is in the financial statements, which I think.
So depreciation increase is mainly coming from SAP, because we have capitalized the SAP project, which was about $4.4 million. Amortization again on the leases. So there have been certain increase in space that we have, especially in head office, which significantly increase the amortization. So it's basically SAP in terms of depreciation, and amortization is on the lease ROU assets.
Okay, thank you, everyone. Maybe if we can take them, the next one sequentially is in which countries you receive tax concessions and how many years are remaining on those. So maybe Rowan or Navoja, just briefly touch on that.
So we have tax concessions in Kenya and Ethiopia currently. Ethiopia, we do have 4 more years to go, and Kenya also we have about 3 more years to go.
Yeah, okay, thank you. On the next one, there's a question from which market did most of the adverse effects come? So I'm going to interpret that that's on the terms of the revenue performance, whether we see any difference across the markets in which, across our export markets, so primarily against the US versus Europe. So maybe you can add on that.
I think, like we said, in one of the previous investor forums also, it's what we are starting to see is that it's not specifically related to a market, but it's whether the particular brand or retailer is, the particular brand is sold mostly through wholesale channels, or do they have direct to consumer access, which doesn't only resort to online, but even having their own stores. So what we've seen is that brands who have a high exposure to wholesale channels tend to be affected a lot worse than those who have better control through their own distribution channels. So yeah, what we've done over the last 12 months is to really increase our penetration with those brands that have their own retail stores or a strong online presence.
The raw materials.
What's the current status of? Raw material prices have somewhat stabilized. There's some marginal increases that's coming through certain supply disruptions when it comes to yarn and stuff like that. But overall, because of the open capacity situation globally, prices are still somewhat holding. But we are starting to see early signs of that increasing, and that's mostly due to macro conditions, including the Red Sea saga.
Yeah. So I will maybe take the next one, which is on focus brands, and maybe Rowan, Navoja, you can add to this. So the question is, going forward, how much will focus brands contribute to the top line, and how much contribution to revenue growth will come from focus brands? So I think what we can say at this stage is, and as we indicated it's in the slide as well. So in the 12 months to December, focus brands had a revenue of about an annual revenue of about $100 million. And the consolidation in terms of the P&L will come in Q4 for the 2 months. So that's February and March. So you will see it positively contributing to revenue from the fourth quarter. Of course, the full quarter impact will only come in the first quarter, but it will be a positive impact for sure. It's just at this stage, we're not giving guidance on how significant it will be. We're just giving you the historical revenue number as additional context. Okay, maybe this next one. What part of the operating cost savings is expected to be permanent in nature, and what part is expected to go up again with the expected increase in revenue? So maybe Rowan, if you could add some context on that.
Yeah. So as per our P180 initiatives, I would say around 85% to 90% of the savings are from recurring costs. We have also had certain one-off gains as well in terms of other income, that in terms of sales that we have done of fabric, right, of fabric and etc. But about 85% of savings or line items will continue for the next financial year as well. In terms of revenue, I mean, if revenue grows, obviously, like the manufacturing costs, like say manufacturing cost can go up in terms of subcontract or our own manufacturing, but we're trying to ensure that we do not increase the SG&A cost as of, I mean, with the corresponding sales increase. So that's maybe about 20%, 25% of our cost is manufacturing. That could increase in terms of with the sales increase, but we're trying to keep SG&A costs flat.
I think just to add to that, I think if you're alluding towards how much of these cost savings are variable versus fixed, majority of it, like Ron said, 85-90% is variable because it's coming in the form of salaries and headcount. So we are just in the process of finalizing our budgets, and what we're trying to do is to make sure the resources that we have in this current structure is sufficient to service the revenue growth that we're expecting for next year. There will be certain variable costs, again, like Ron mentioned, like manufacturing overheads, but our strategy is to keep our internal capacity fairly fixed. We don't want to scale it up. In fact, we will potentially explore more consolidation opportunities. And then any unforeseen incremental revenue growth that we see, we will look at working with third-party manufacturers.
Yeah, I think that relates to another question which we have, which is a bit further down, is what challenges would you have if you were to increase capacity in future again?
It depends where you're going to increase it. If it's in Africa, it's fairly straightforward to increase because the abundance of labor is there. There's potentially a lot of there will be a sufficient trained employees that we could recruit on day one itself. If it's in Sri Lanka, it might be a little bit more challenged than in Africa, but a lot easier than what it was maybe 2-3 years ago. So don't see a major challenge in scaling up, but it's really around the consistency of demand. We don't want to increase our fixed or cost overhead base till we have better visibility on the consistency in the revenue generation and of course margin, because right now we are seeing severe margin pressure on our manufacturing division. So if we keep our capacity, limited and the rest coming from flexible capacity, it'll be fairly easy to drop any programs or customers who don't make financial sense to maintain.
We also had a question on asking for further information on the composition of cost of sales. So maybe, Rowan, if you could just write that down at a high level.
Yeah, so major part is the raw material costs, which is around 60%, and rest is the manufacturing overhead, which is around another 25%. So that's the composition of our cost of sales.
Yeah, thank you, Ron. In terms of, there's a question on whether the forecasted capacity is based on real figures. So I will take that one. So that is based on a combination of confirmed purchase orders, which we have in hand, and projections. But what I've shown you in that chart is only January through March. So it is 80-90% confirmed orders. There is a small portion of the March figure, which is on projections, but that is largely confirmed purchase orders. Yeah. So I will leave it at that. Which one?
We need to take JD Sports.
So a question on, does Focus Brands still get stocked at JD Sports outlets in the UK? So the short answer to that is yes. There's no reason for Focus Brands' relationship with JD Sports from a sales perspective to change in any significant way. And that opportunity is certainly still open for Focus Brands. There's a question on geographical base top line composition. So I would refer you to the chart, which is included on, I believe, the third or fourth slide of the presentation when we send that out. But feel free to do get in touch if you have any further questions on that directly via the investor relations email address. a couple of questions on demand. Yeah, maybe 10. Yeah. So we have just a general question on how the demand picture looks in the US, UK, and Europe, and then also bringing into that focus brands and how that might impact going forward. So Dilanka, if I can give that one to you.
Yeah, I mean, the demand outlook seems positive, or at least you can be optimistic about it. And it's not because demand is increasing as such. I think it's more the correction around the inventory levels. So this quarter, we are seeing about I think 25 to 30% growth from the previous quarter. Whether that will sustain is what we are yet to see. But then, once we have our cost base and capacities at right size, then it gives us the freedom to navigate up or down depending on how the demand trends. But yeah, I mean, I think there was a question around who our top 3 to 4 customers are. I mean, our largest customers are Kelvin, Tommy Hilfiger, Tesco, and VF. So VF is the company that owns brands like North Face, Timberland, Dickies. So those 4 still trend strong. It's just that for PVH or for VF, a large component of the sales in the US come from wholesale channels. So the impact they're facing trickles down to us. So which is why we've updated in the previous quarterly earnings reviews why brands like Hugo Boss to Castro to and many other retailers are important additions to our portfolio, so that it kind of softens the blow that we're having on our bigger wholesale customers.
Yeah, thanks, Dilanka. So there's a few questions on the financial outlook around when we'll see a break-even profitability scenario, and also the impact of the current losses on the balance sheet, so particularly the net asset value or the equity position. So maybe, yeah, Dilanka, you want to take that?
So I mean, we're trending towards, I mean, even though our Q3 numbers weren't as ideal as we would have liked, I think there's a lot of positives that we can take from it, including us turning towards profitability in the month of December. So it's that run rate that we want to now continue, because for us, it's about, getting that proof of concept right, and then kind of scaling it up subsequently. So we do expect Q4 to be positive, of course, helped by the consolidation of focus brands. But again, it's about building up from there in Q1 and the subsequent quarters.
So there's a question maybe on some of the new customers. So last quarter you mentioned the expectation of receiving numerous orders from Nike and other sports brands. You also mentioned that for some of these customers, negotiations are still ongoing.
Yeah.
Can you provide an update on these and maybe when they're going to have a significant contribution?
Sure. I mean, what we can mention is, with the likes of Nike, like Adam mentioned, we've also now expanded into their second brand, which is Air Jordan. The first test order from Air Jordans is over 600,000 units. And that was because we successfully delivered our first delivery to Nike in January 31st this year. So it is becoming scalable quite fast. A customer who we've been expanding a lot on in these investor forums has been Castro. So we are looking at about 50 to 60% growth with Castro and the other strategic customers that we've been kind of highlighting over the last few forums. So the new customer base is positive. I think we could use 1 or 2 more, especially to fulfill Africa's potential capacity. So that's what our focus is over the next few quarters.
Yeah. Okay. Thank you, Dilanka. So there's a question on gross profit margin trajectory in particular. Yeah, Shannon, if you scroll down to that one, and whether we will expect to see an improvement in gross profit margins in the coming quarters, and how we expect the consolidation of focus brands to impact gross profit margins. So maybe, Ruan, if I could give that to you to discuss a bit more on the outlook for the gross margin.
So in the apparel business, GP margins will be challenging, but with consolidation, with focus, actually they're coming at a higher GP margin than our apparel manufacturing business. So we could certainly see improvements, but in the apparel sector, manufacturing business, we still see a bit of a challenge in terms of improving our margins.
Yeah, we should see, I think it's fair to see in the private label manufacturing division, we do expect to see an improvement in gross profit margins. They will just likely in the next quarter looking still below the levels that we would expect
like
and
to
look
be.
for.
But the highest in the previous 4 quarters. Yeah.
Exactly. Yeah. Okay. Maybe there's a few questions on the balance sheet and the acquisition financing, but maybe before that we can do the Red Sea and what impact that's had on Hela.
Yeah.
So Doran, if I give that to you.
I mean, truth be told, it's a huge impact. I think Hela is probably more impacted than some of the other manufacturers because of our country of origin footprint. You know, with a lot of our manufacturing facilities being in Africa, we still shift certain raw materials from the Indian subcontinent region over to there. So we see about a $1 to $1.2 million impact on an annualized aspect in terms of increased logistics and insurance costs. It's mitigated quite a bit because we have contracts with our major shipping lines, contracts that we signed in April last year. So the real increment is coming only on certain routes or in the form of insurance premiums. We are also talking to some of the customers to pass on that logistics cost in form of increased prices. It's not the most easiest conversation to have because when other manufacturers are reducing prices, other manufacturers in the Indian subcontinent are reducing prices. For us to increase prices out of Africa is a difficult conversation to have, but it's one that they're taking, and we are seeing mixed results. But yeah, so it's a serious challenge. But there are solutions around it, and two of them I mentioned, and the last being we have to use more local raw materials so that we can avoid the freight aspect altogether. And that's this situation has helped us in a way to convince customers to make that switch a lot faster. So there's a lot of work streams going on to negate that impact, but there is an impact for sure.
Great, thank you, Delanka. So to come on to the balance sheet, so 2 different questions. One was a question on how the Focus brand acquisition was financed. And then we have a question on the current composition of fixed rate and floating rate borrowing and anything we can say about interest rates. So Naboja, I can let you take those.
Sure. So first touch on the acquisition financing. So the acquisition consideration was about £8 million, which converts to $10.5 million. So that was financed through shareholder support and also cash reserves that we had in Focus itself. And moving on to the interest rates. So 98% of our borrowings are at floating rates. So it's very minimum that we have at fixed rates.
Yeah. Okay. There was a couple of other questions on the acquisition. So just to clarify, yes, the company that we have acquired is Focus Brands Limited, which is the UK-based company. Just to be clear on that. Then in terms of this question on produced units or volume during the quarter, that is a little bit tricky to say because it varies very significantly between product type. So that is why we generally talk about produced standard hours in this presentation, because that is the best way to measure our capacity rather than looking at product levels, because there is such variation between our products as well. Just a few final questions. Maybe a question on the impact from increasing electricity prices or utility expenses. I guess whether we're seeing anything from that.
It's marginal. It's not a massive impact that we're seeing, and we're also taking up the latest CEB offer to change the costings, the pricing scheme by using the solar that we generate. So we're seeing about a $10,000 to $15,000 net increase per month, but it's something that we can stomach.
Yeah. Okay. I think we have covered most things, so I think we can probably wrap this up.
Yeah.
Thank you very much for all your questions and to everyone who joined the call. We really appreciate you taking the time. If we have missed anything or if you've got any further follow-ups, please do feel free to email the investor relations email address or investors@Hela Clothing, and we will come back to you. But with that, it just leaves me to say thank you very much for your time. We look forward to speaking to you next quarter. All right, thank you.